Welcome to Talk Tickers, your shortcut to what really matters in the quarterly earnings landscape. Today, we're doing a deep dive into Synchrony Financial, that's SYF, looking at their results and forward look after their call this morning, October 15th.
Yeah, and our goal here isn't just reading off the numbers. We want to weave together the quantitative results, the beats and misses, with what management actually said, the qualitative stuff, to give you that full context experience investors need.
Okay, let's get straight to the punchline then, because the profitability this quarter was, well, pretty exceptional for Synchrony.
It really was a strong third quarter, marked by really standout profitability. The bottom line, a massive beat.
Massive how?
Well, they reported GAAP earnings per share, EPS, of $2.86. Now, consensus was looking for something closer to $2.22.
Wow, okay, so that's like a 29% upside. That's huge for a company this size.
Huge delta. And on the top line, net revenue landed at $3.82 billion, which was just a hair above the $3.88 billion consensus.
Yeah.
Slight beat there.
But the real story seems to be converting that revenue into profit. Net income was around, $1.1 billion, and the returns looked stellar.
Stellar is absolutely the word. We saw return on average assets, ROAA, hitting about 3.6%, and maybe more importantly, return on tangible common equity, ROTCE. That was an eye-watering 30.6%.
30% ROTCE.
Right.
In consumer finance, that's really top tier, right? It shows incredible efficiency.
It's best in class, full stop. It really demonstrates how effectively they're turning their capital into profit, a very tightly managed machine.
Okay, so here's the puzzle. 29% EPS beat, 30% ROTCE. But the stock reaction pre-market was pretty tame, up only about 1.6%, you said?
Yeah, pretty muted.
A beat this clean, you'd normally expect more excitement. So what gives? Is the market worried about guidance or digging into how they got this beat?
I think that's exactly the tension. Investors are always looking forward, right? So maybe some concerns about growth constraints. But this specific EPS beat, it really came from looking backward at just immaculate credit execution over the past year or so.
And the cost of funds you mentioned.
And their funding advantage? Absolutely. Those were the two big levers, credit discipline and funding costs.
All right, let's unpack that credit quality first, because the numbers seem to confirm those tightening actions they took, starting mid-2023 into early 24 really paid off.
They absolutely did. The credit metrics were maybe the biggest positive surprise. Take delinquency. The 30-plus day rate actually decreased year over year.
Yeah.
Came in at 4.39%.
Okay, lower is good. But how does that compare historically?
That's what's fascinating. That 4.39%, it's actually 23 basis points below their historical average for Q3 from the 2017 to 2019 period.
Below pre-pandemic, pre-recession norms.
Exactly. Performing better now in this environment than in what we'd consider a more normal economic time. That shows real underlying strength of the portfolio they've curated.
That speaks volumes about their underwriting discipline. And I assume charge-offs followed suit.
They did. The net charge-off rate saw a big decline, down 90 basis points compared to last year, landing at 5.16%.
Okay, 90 basis points is a serious improvement.
Right. And you see the knock-on effect on the balance sheet. Their allowance for credit losses, the cash set aside for potential loan failures as a percentage of their loans, it ticked down slightly to 10.35%.
And that wasn't just changing forecasts, you're saying?
No, management emphasized this was driven by the actual observed improvement in their internal credit performance.
Yeah.
They just have more confidence in the borrowers they have right now.
Okay, so credit was rock solid. What about the other side managing funding costs and the lending spread?
Yeah, the net interest margin, or NIM. That expanded nicely, too, up 58 basis points year over year to 15.62%.
So their profit margin on lending activities got wider. What drove that?
Two main things. First, a big one, a 58 basis point decline in the cost of their interest-bearing liabilities. Basically, their funding got cheaper. That's a significant tailwind.
Lower funding costs, always good. What was the second factor?
The yield on their loan receivables actually went up by 35 basis points. They pointed to PBPC's product pricing and policy changes.
Meaning they tweaked rates or fees?
Essentially, yes. Targeted adjustments to boost profitability. Likely possible because the overall portfolio was performing so well from a risk perspective.
It sounds like textbook execution on risk management and balance sheet optimization. But, here comes the growth question. Purchase volume was up, right? About 2%.
Yeah, purchase volume hit $46 billion, up 2%. Saw some decent strength in digital, diversified value, health and wellness, all up around 3-5%.
Okay, but ending loan receivables actually decreased 2% year over year, down to about $100.2 billion. How do you square that? Spending is up, but the loan balances are down.
That's the other side of that credit discipline coin. Remember those tightening actions? They were intentionally restricting loan growth last year, turning away some volume. And crucially, the payment rate remains really high.
People are paying down their balances faster.
Much faster. It was up 60 basis points year over year to 16.3%. So consumers are spending, yes, but they're also aggressively paying off debt. That signals some caution out there, maybe, but for Synchrony's risk profile, it's fantastic, even if it temporarily caps receivable growth.
Okay, so the past performance, the Q3 numbers, look immaculate, built on strong credit. But the market wants future growth. And it sounds like management is signaling a shift now, right? Moving away from pure contraction.
Exactly. This is where it gets really interesting. They're talking about a pivot towards selective, risk-adjusted growth. They explicitly mentioned a credit aperture shift.
Meaning they're loosening the standards again.
Gradually and surgically. They said, because their past tightening worked better than expected, they've started to carefully reverse some of it. Their plan is to add back roughly 30% of the sales volume they estimate they lost due to those earlier restrictions.
But how are they doing that? Are they just lowering FICO score cutoffs?
No, and they were very clear on this. The focus is on things like upgrades, offering better cards, maybe dual cards, to existing customers, and giving credit line increases to people who've already proven they can handle the credit. They are not doing broad-based loosening across the board just to chase volume. That would be a red flag.
That makes sense. Keep the core quality, but reward good customers.
Right. And they shared an interesting insight. They found that their earlier actions effectively removed the riskiest slice of the non-prime segment. So the non-prime customers they still have are actually showing stronger spending patterns, transaction value, frequency. They managed to de-risk without completely killing that segment's activity.
Smart. So what are the catalysts they see driving this new growth phase? Any big partnerships or product pushes?
Definitely. The biggest news is probably Walmart. That new co-branded card just launched in September.
How's that going?
They described it as a great start. Management sounded quite bullish, suggesting its value proposition, especially that 5% cash back for Walmart Plus members, and the deep integration to Walmart's app could make it a potential top 5 program for Synchrony over time.
A top 5 program is significant. Anything else on the partnership front?
They're also expanding with Lowe's, building out the commercial program there, and they're actually acquiring the Lowe's commercial co-branded credit card portfolio. That deal should close sometime in the first half of 2026.
Okay, strengthening existing ties. What about newer products like Buy Now, Pay Later?
Yeah, they highlighted success with their Pay Later installment product, particularly at Amazon, but also rolling out with other big partners like Lowe's, JCPenney. It feeds into their multi-product strategy, offering both traditional revolving credit and these fixed payment options, meeting the customer with the right product.
And they made a small acquisition too, right? Versatile Credit.
Yes, small but strategic. Versatile Credit is a multi-source financing platform. Think of it as helping merchants increase approval rates. If Synchrony can't approve a customer, Versatile can help find another lender who might.
Ah, so it fits into that embedded finance idea, being part of the checkout flow.
Exactly. It accelerates that strategy, and it also generates some non-lending referral revenue for Synchrony. It's about being the financial gateway at the point of sale, not just the direct lender sometimes.
Okay, so a clear plan for reigniting growth selectively, which brings us back to the guidance and maybe why the stock reaction was a bit hesitant. What did they actually guide for going forward?
Right, this is where that initial confusion might have come from. They actually trimmed the full year 2025 net revenue range slightly, guided to $15.0 to $15.1 billion. So the midpoint came down just a touch.
Hang on. Massive profit beat driven by great credit, but they trimmed the revenue guide. That feels backward. Explain this revenue paradox.
It does seem counterintuitive, but this is actually maybe the best part of the story, fundamentally speaking. The revenue trim is happening because their credit performance is so good.
How does that work? Good credit lowers revenue.
In a way, yes. Better credit means lower delinquency rates. Lower delinquency means fewer customers paying late fees. And late fees, they count as revenue for Synchrony.
Ah, okay, so fewer penalty fees.
Exactly.
Yeah.
Plus, remember that elevated payment rate. People paying down balances faster means less interest accrues over the life of the balance. That also dampens interest revenue compared to a scenario where balances revolve for longer.
So they're losing some fee and interest revenue, but presumably the reduction in losses and provisioning costs more than offsets that on the profit line.
Precisely. They're treating slightly lower but higher risk revenue for significantly lower credit costs, and therefore much higher profitability. It's a sign of quality,
Well,
even if it looks odd on the surface revenue guide.
okay, that makes sense. It's a quality trade-off. And presumably, the loss guidance reflects this strength?
It does. They improved the full-year loss rate outlook, now expecting 5.6% to 5.7%. That's nicely towards the low end of their long-term target range, which is 5.5% to 6.0%.
And all this confidence seems to be flowing through to capital return plans, too.
Big time. They backed up the confidence talk with action. Management got authorization to increase the share repurchase program by another $1 billion.
Adding to what they already had.
Yep. That brings the total available buyback capacity to $2.1 billion, running through mid-2026. And they're not sitting on it. They returned almost $1 billion, $971 million, to shareholders just in Q3, mostly through buybacks, $861 million.
That's aggressive. They're essentially saying our stock is cheap and we have excess capital.
That's the signal, loud and clear, especially with that ROTCE running so high.
So putting it in context, Synchrony lagged the financials ETF, the XLF, over the last few months, maybe on those growth concerns. But long-term, they've actually outperformed significantly. And now, with credit trends maybe stabilizing across the sector and potential rate cuts on the horizon, they seem pretty well positioned.
I think so. That combination of proven credit management, best-in-class returns, and a massive buyback authorization is pretty potent. Few competitors can match that specific mix right now.
Which brings us nicely to our next segment, a reminder to everyone listening, this is purely a thought experiment. This is not financial advice.
Okay, disclaimer acknowledged. So, given everything we've discussed, that robust 30% plus ROTCE, the huge Q3 EPS beat that the market sort of shrugged off, and that very large active $2.1 billion buyback authorization, my outrageous but plausible pitch is actually a high conviction, maybe shorter dated, long position using leveraged call options.
Okay, calls. Why leveraged and why short dated? Why not just buy the stock if you like the story?
Because the thesis is about a potential rapid re-rating. The market seems overly focused on that tiny revenue guide trim, which, as we've established, is arguably a good sign reflecting credit quality.
Right.
So the bet is that the sheer velocity of that $2.1 billion buyback, actively shrinking the share count, combined with the strong forward guidance on low loss rates, forces the market to recognize the underlying earnings power pretty quickly.
You think the buyback acts as an accelerant for the stock price, overcoming the revenue narrative?
I think it mathematically has to, especially if they execute aggressively. Lower share count plus stable to improving earnings per share, driven by that low loss rate. That combination tends to drive stock prices up sharply. The options provide leverage to capture that potential sharp move if the market wakes up to the quality story relatively soon. It's a bet on the buyback forcing the issue.
Interesting. So, to wrap up today's deep dive, Synchrony's quarter was really defined by that durable profitability driven by excellent credit management. They backed it up with aggressive capital return, and they're now strategically pivoting towards growth, leaning on big wins like Walmart and embedded finance plays like Versatile.
Yeah, and I think the ultimate question for you, the listener, to mull over is this. Management is starting to gently open that credit aperture again. Will the growth from these new initiatives, like Walmart gaining steam and the BNPL products expanding, kick in fast enough before the inevitable normalization of credit starts to reverse some of the exceptionally favorable loss and delinquency trends we just saw?
It's a timing question, a race between that new growth hitting its stride and credit metrics eventually drifting back towards longer-term averages.
Exactly. Can they ramp up growth before the tailwind from pristine credit fades? That's the key tension to watch.
A lot to think about there. Thank you for joining us for this deep dive into Synchrony's earnings. We'll be back soon with more insights from the market.